Hey everyone, in this video I'm going to compare three EV companies and answer which one I think is the better EV stock to buy today. The three EV stocks I'm going to compare are Tesla, Rivian, and NIO. So without further ado, let's jump into this interesting comparison.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so the first thing I'm going to compare these three EV stocks on is revenue. And you'll notice that Tesla is head and shoulders above the rest here in terms of total revenue. And it's growing at a rate that's likely to be faster than the others also, except maybe NIO might grow faster. In fact, NIO is likely to grow faster in the next 12 months, but I don't think Rivian's going to grow faster than Tesla, even though it's significantly smaller than Tesla. Rivian suggested that 2024, it's not going to increase production at all. So if it's not going to increase production, I don't think the increase in revenue is going to come from higher average selling prices. And so I don't think Rivian's going to grow by very much, while Tesla hasn't really indicated, hasn't given us a target in what their production number is going to be, but it's likely to be larger than where it was the year before. And considering that it just launched the Cybertruck, if more of those Cybertruck sales come in, their average selling prices are much higher than the other models. And so it could increase average selling price as well. And it looks like Tesla has stopped with the price cutting, actually reversing that and increasing prices about a week ago. So if it continues holding prices firm and the mix of car sales starts to include some of those Cybertrucks, especially towards the end of the year, it could have average selling prices that were higher than the previous year, although also unlikely. I think more likely is average selling prices are down industry-wide in 2024. NIO, meanwhile, launched several new models in the summer of 2023, and those models are lifting sales considerably for NIO as customers have appreciated the updated look. NIO also hired more salespeople to match with other car companies that had more salespeople. NIO wanted to match, saying that they were significantly behind in terms of salespeople. And NIO, unlike Tesla and Rivian, is taking an interesting strategy with the battery swapping technology, which makes it more convenient for people that have EVs because you can swap your battery instead of having to sit there and charge it. Now, that remains to be seen if that provides a differentiator longer term for NIO or not. But from this perspective, recharging time is one of the most inconvenient feature of EVs. And if you can alleviate that somewhat, that's going to give you an advantage in this industry. The next thing I wanted to compare these three EV stocks on is their balance sheet. I wanted to look at how much cash they have and how much long-term debt they have. And in this case, Tesla with 29 billion in cash and short-term investments up against 4.6 billion in long-term debt has the strongest balance sheet. Rivian has $9.36 billion in cash and short-term investments and $4.4 billion in long-term debt. Also not so bad, over 2-to-1 ratio. And NIO as well, $7 billion in cash and $3.2 billion in long-term debt. Also over 2-to-1 ratio in cash to long-term debt. Cash was plentiful for these EV companies in 2020 and 2021. Given the surge in popularity of EV stocks, it was an absolute frenzy. And so these EV companies were able to raise almost as much capital as they needed at very low prices because of that frenzy for EV companies. It's become much harder now, so they've gotten much more careful. Rivian lately, remember, it said that it's going to pause production on its Georgia manufacturing facility in an attempt to conserve cash and fulfill its current manufacturing capacity. It doesn't need any more manufacturing capacity. I highlighted already that it's not increasing production in 2024, and it's only at roughly 1/3 of its existing manufacturing capacity. So why add more manufacturing capacity when you don't need it yet, right? Especially when cash is so expensive right now, given the increasing cost of capital. So prudent decision from Rivian there. And overall, Tesla with the better balance sheet here, the best balance sheet in terms of the ratio of cash to long-term debt. I also wanted to compare these three on their inventory turnover ratio. This is important to me because when you're looking at car companies, one of the biggest capital expenses or working capital expenses is inventory. Now, I've included Neo here, where previously I wouldn't have included Neo because when you're outsourcing production, inventory is not as much of a concern. But now that Neo purchased its manufacturing company, it will now be manufacturing itself. It's not going to outsource manufacturing anymore. The inventory turnover becomes much more critical. It's a vital metric for car companies. And here you can see Neo with the best inventory turnover at 7.8, while that's down from the peak levels in 2021 and 2022, early 2022. But that's true for the EV industry overall. Customers, now that they have a choice, now that supply chain constraints have eased and people can buy legacy combustion engine automobiles, more than 9 out of 10 people are choosing legacy internal combustion engine. So the EV demand from consumers has been decreasing since supply for internal combustion engine vehicles has been increasing. Nevertheless, Tesla with the second best rating here at 7.021 inventory turnover. And then the slowest here is Rivian at a 2.115 inventory turnover, considerably slower than the other two in terms of building inventory, turning it into sales. It hasn't been as effective as Tesla or Rivian in this metric. The next thing I wanted to look at is arguably the most important, and that is net income, profitability on the bottom line, and Tesla doing the best in this metric here, 15 billion in profits on the bottom line, and its profits have been steadily increasing over the last 3 years, and the others are going in the wrong direction. Neo's net income trailing 12 months negative 3 billion, so they lost 3 billion in their most recent trailing 12-month period, and Rivian lost 5.4 billion in its most recent trailing 12-month period. And these two are likely to continue losing money on the bottom line for at least the next 12 months, perhaps even longer than that. So Tesla with a huge advantage in this metric, which is arguably the most important metric, especially as the cost of capital increases. The importance of profitability on the bottom line increases because you're unable to fund your losses at very low costs of debt or at very low costs of equity. And so when you're losing money, it's costing you more with each incremental loss, right? When the cost of capital is higher. So finally, I wanted to compare these three on valuation, and understandably, Tesla is the most expensive here according to its forward price to sales ratio at 4.2. It's roughly 3 times as expensive as Rivian at 1.4, which is roughly 2 times as expensive as Neo at a forward price to sales of 0.767. Still, if I was choosing today, I would say that Tesla stock deserves this premium valuation, and I would pick Tesla stock as the best EV stock to buy today out of these three. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.